Hello, welcome back to Hurdle Rate. Today we're going to do something a bit different. We're going to do an analysis of the balance sheet for Uber. We're going to look at the liquidity and solvency ratios and try and assess the health of the company. So let's pull up the balance sheet. So Uber Technologies, let's search for it. Yeah, we just need the latest 10K, which is, where is it? There we go. And instead of going open document, let's go open filing. Let's open this one that ends in .htm. It'll take it'll take a few seconds to open. Actually, what we'll do, come back and go interactive data. This button here. Come down, come financial statements, condensed consolidated balance sheet, and let's just copy this over. Oh, perfect, there we are. So first of all, let's clean up our spreadsheet. As always, go to page layout. Let's remove the grid lines, and we can actually come into a full screen now because we are what do you call it? Yeah, because we don't really need that. We've got all of our data here. So I'm going to zoom in a bit. Not that much. Let's just make this all a bit. Okay, yeah, we can see everything there. And what we can do is we just need to sort of make it a bit more visible for just make it a bit cleaner, I guess. So yeah, we have the dates. So this is the most recent. This is on the most recent 10Q. That's June 25, and this was what the balance sheet was at the end of the previous year, end of 2024. So we have our current assets. Let's make this into go fill. Sorry, I need to have a bit of have the white font there as well. Automatic, there we go. Maybe let's just add a space up there. Oh, there. There we go. Then, so we need to separate the assets with the liabilities and the equity. So put total assets, let's bold that at the bottom here. Then total current assets, let's bold and italicize. And this, yeah, this all looks good. Just highlight all of these in the current assets, and we'll do it the same with the others as well. We'll go number. We don't want decimal places. We want the thousand separator, and we want the style for negative numbers to be in brackets. There we go. But why are these two not? We don't need the... There we go. And what we can do is on total current assets, we want, basically this is just the sum of all of these. So we go sum, just add all of them together, copy that over so that it's, and then we do the same with the total assets here at the bottom. We go equal sum, all of the long-term assets, and then add the current assets in there as well. Yeah, sorry. You've got to make sure it's the same thing that it's added up together, otherwise it can mess up. Okay, yeah, looking good. There we go. Okay, we've got to do a bit of something a bit similar here. So total liabilities, bold and italicize. We go sorry, we don't bold and italicize, we just leave it in bold. But we do for current liabilities. We go equal sum. Perfect. Okay, now let's look at, so this is the equity part. There we go. Okay, and this is just going to be the sum of everything basically. So before we, okay, so what we want to do here is, so total, so yeah, let's just do the sum of, so total equity is the sum of the additional paid in capital, the accumulated other comprehensive loss, and the accumulated deficit. Yeah, so just make sure you remember so what this figure was before when we're doing it, just so that they are the same. Equals sum. Yeah, looks good. Therefore, the total equity is perfect. And now this one down here is going to equal the sum of your total liabilities, this one, and the equity. There we go. Perfect. Okay, now we can start. So we're going to be looking at let's bold this so that we know that it's a actually not that one. Let's bold this one. There we go. Okay, so we're going to be looking at liquidity ratios, and also afterwards we'll be looking at solvency. So we'll address them as we're going on. In the liquidity, we're looking at the current ratio, the quick ratio, and come down a bit, and the cash ratio. And this is all, these are all ways of understanding how Uber can pay its obligations over the next year. So let's start with the current ratio. Your current ratio is your total current assets divided by your, okay, I'll write it out. It's the total current assets divided by your total current liabilities. And what we're going to do is we're going to look at this for this period. No, undo that. I'll write it in. So June 24 and December 25. We're going to see whether what is a good range for each of these to be in, and whether Uber is healthy or not. So your current ratio, it's going to be your, so for June 24, we take our total current assets and we divide it by our total current liabilities. So when it says current, it means its ability to meet its obligation. Current is anything that's going out in the next year, so or can be used within the next year. So current for 24 is 1.06. Let's put this into number, 2 decimal places. So let's go 1.7. Let's look at what the current is. This is for the previous year, the June 24 figure. So we take our total current assets divided by total current liabilities. And as we can see that this is getting higher, let's say so. Okay, I'll come out a little bit so we have a bit more space. Okay, we want to know what let's go healthy range here. And that is going to be, so anything above, what would we say? I think between 1.5 and 2 is a healthy range. So we want to see this between 1.5 and 2. Anything above, well, anything below that means there could be a possible liquidity issue, and over 2 could mean that there are idle assets. So that's not great. The quick ratio, and it's like the current ratio, but it's without inventory. So it's total current assets minus your inventory divided by your total current liabilities. And Uber's well, in this case, as you can see, Uber doesn't have any inventory. Therefore, it's going to be the same as the current ratio. So yeah, we just do the same thing again. If we were doing a retail, say like if we were doing a Target, we would see inventory and we would do our total current assets and subtract inventory. But because it doesn't have that, we don't, and we just do as we were doing. Sorry, I've done this wrong. I did the wrong year. So there we go. Again, just do a bit of formatting, and yeah. The difference now is, whilst the current ratio, the healthy range was between 1.5 and 2, for your quick ratio, you want it to be more than 1. So a healthy range is greater than 1. And this means that it has enough liquid assets, cash, receivables to pay for short-term liabilities. Less than 1 suggests there's a dependence on selling the inventory to meet those obligations. So as you can see, like Uber's, it's above 1, but it's not. It's just above 1, but it's heading in a positive direction. It's getting larger. So from that perspective, we can see that Uber is fairly safe, even if the current ratio isn't in the ideal range. But we can see on the quick ratio that it is okay. For the cash ratio, this is going to be the cash and cash equivalents. So we say cash equivalents plus, I guess, short-term investments and any of these restricted ones, restricted CCE divided by your total current liabilities. And this is the strictest ratio to measure liquidity. So yeah, let's do that. We're using the restricted ones because when it's restricted on the current, it means that they will be available within the next year. And we're talking about Uber's ability to meet its liabilities for the next year. So let's do that. So we go sum divided by total current liabilities, 0.66. Let's do the same for 2025 divided by current liabilities. So, I mean, we can see there that the, sorry, let me come back full screen. There, yeah, we can see that they're fairly similar. A healthy range for this is usually 0.2 to 0.5. And as we can see, Uber is higher than that. And it could mean it's not the best efficient asset use if this figure is too high. But it's good. It means that Uber does have sufficient liquidity to meet its short-term obligations. But it doesn't necessarily mean it's operating in the most efficient manner. So yeah, that's Uber's Uber's state at the moment. And the importance of the balance sheet is that it shows you what the company owes, and what is left over for equity holders at a fixed point in time, and that's usually at the end when the earnings are released. So yeah, those are the liquidity ratios. We'll now move on to the solvency. Let's come there. Bold. Yeah. Okay. So the first one we're going to look at is the debt to equity ratio. Sorry, don't need to bold it. And that is the total debt divided by the equity. And total debt does not mean total liabilities. It's an easy mistake to make, that we just go, oh, great, we're just going to use this figure. We have to see on here what is, I guess, interest-bearing debt. And we'll take that as long-term debt net of current portion, 9578. Well, that's for the latest year, 8347 for the previous. But yeah, otherwise there's no other debt. So let's do that. Total debt divided by equity. So we're going to be really just using the bottom half of this now. So we can pull this down. Yeah, I'll zoom in a bit so that we have a better. There we go. June 24. No, December 24, June 25. So the debt to equity ratio is equals, so 8347 divided by your total equity, which is 22383. As we can see, let's just format. So 0.37. Let's do the same for the following year. That is 9578 divided by 2347. And as we can see, this is increasing. So we can do the same again, where we look at what a healthy range is, and this would be, I think, between, say, 0.5 to 1.5. So Uber's, I mean, it's increasing, but it's still, I guess, below the healthy range. If it was more than 2, you would think that this company, it's very heavily levered, it's using a lot of leverage, and it's taking on, which means that it's taking on a lot of risk. But if it's below 0.3, you might think the company is under leveraged. So Uber is close to being under, but it's trending towards the healthy range. Let's do the debt ratio next. And the debt ratio is your total debt divided by total assets. So let's do it. Total debt is your 8347 divided by 51244. For 2025, we take 9578 divided by 55982. And a healthy, I mean, there's not really much debt on Uber, so it's a low figure. It's got a lot of room to run. A healthy range, we would probably say less than 0.6. Let's go less than 0.6. And if it was any higher than this, we would say, this company is overly reliant on debt. Now the equity ratio is just the other way around of the debt ratio. That is going to be, we find our equity down here. So, we'll do the equation first. So we do equity divided by total assets. Whereas this one is debt divided by total assets. Equity ratio is equity divided by total assets. So let's take our equity, total equity divided by total assets, 0.43, Let's do the same. And we can see this is trending downwards. So yeah, there's a healthy, a healthy range for this is above zero point 0.4, and that's why, so it was closed here at 0.44 and it's going further down. So maybe you'd want to see this, this reverse, because once it gets below 0.4, well, I guess below 0.3, you'd think that that's a thin equity cushion and that could be problematic. So the final one, the financial leverage, and that is your total assets divided by your total equity. So for 24, we go, what did I say? Total assets divided by total equity. 2.28. Do the same again. 23477. There we go. And anything, above 3, you'd think there was high leverage and a potential solvency risk. So yeah, 0.3 is risky. Uber's, it's going up, but it's not near there yet. So it is within the healthy range. The healthy range we would say for this between 1.5 and 1.4. 1.5 and 2.5 is healthy. And yeah, when it's in the healthy range, you'd say this is moderate leverage, and it can boost returns without taking excessive risk. So yeah, let's go 1.5 to 2.5 is healthy. So this is a snapshot into the health of Uber. If it were to take a hit to its revenues, how will it fare if it has to, I guess, liquidate its asset to meet its liabilities, and how levered is it based on its solvency ratios? And we can see that at the moment Uber is by and large fairly healthy in terms of meeting both its short-term obligations on its liquidity. You'd want to see the current ratio get a bit healthier, but the other two are fairly good, and it could actually maybe start using its cash a bit more efficiently. Then in terms of its debt to equity ratio, it doesn't really have that much debt, but over the next few years, I probably imagine that to increase. So yeah, I think that's what it is. That's what it is so far. Let's keep doing more of these. And these, if you, before you even do a DCF, just have a look at the balance sheet and just do a few of these calculations to see if there's anything alarming before you before doing the DCF or any other valuation. It just gives you a little insight into the health of the company. So yeah, but that's it for today. I think at some point we will do a DCF of Uber. So yeah, well, I'll see you on the next one. Thanks for listening. Bye.